What's up guys, this is Akash. This is the first video of our stock market series. In this video, I'll cover up what stock market really is and how it really functions. Before that, why invest? Investing in the financial markets is very important because it can generate revenue that can actually beat inflation. So what is the stock market? Stock market is just like a supermarket. As we go to the supermarket to buy goods, we go to the stock market to buy equities. If you're a buyer, the stock market itself will find a seller for you and vice versa. Before we go deep into the stock markets, let's discuss what equities actually mean. In order for me to explain that, we need to start with the origin of a company or a business. Imagine a budding entrepreneur with a brilliant business idea, and he knows for sure that his business is going to be a big success. But the only problem is he does not have the capital required to fund the business. Now let us assume that he pools in his own money as well as his friends to start off this company. Now these two friends who he received the money from to start his business are called angel investors. This initial capital that they raised will sit in the company's bank account. The owner and the two other angels will be issued their shared certificate according to how much they invested into that particular bank account. Let's say 50% is actually allotted to the investors and 50% is actually retained by the company itself. When the business starts picking up, naturally the owner wants to expand his business. Since he is generating good revenue, he can approach a venture capitalist at this point. A venture capitalist or a VC is someone who invests in a company at its early stages. Let's say the company gave 10% of the shares to the VC and now the company has 40% shares with them. With additional investment, the business grows again, generating more revenue. After a few successful years, the company is generating more and more revenue, and this time they want to expand, but they want to expand on a much larger scale. To raise more funds for their expansion, they can either take money from their profits, or they can approach another VC, or they can take a loan from the bank. Let's say at this stage we gave another 10% of the company shares to another VC. Now the company has 30% of shares left. A few years after this round of investments, the company wants to expand further, let's say globally. This time the investment required is huge. They can either approach more investors or go public. Going public means they're offering their shares to the general public. Now the company still has a 30% left to offer to the public. This share that is being offered to the public is what general people, that is us, are buying and selling on the stock market. The company's initial offering to the public is called IPO or initial public offering. You can either buy these shares of the company in the IPO, or you can also buy it when the stock is actually listed in the stock exchange. There are mainly two major stock exchanges in India. One is the National Stock Exchange, NSE, and the second one is Bombay Stock Exchange, BSE. Back in the olden days, if you wanted to buy a particular stock, then you would have to go approach a stockbroker or go to the exchange yourself and buy a particular stock. But nowadays, everything is done electronically. Stockbrokers are probably the most important intermediaries that you have to know. They are a corporate and holds a stockbroking license. Once you open a trading account with a stockbroker, they will act like a gateway to the stock exchange. In India, some of the most famous discount brokers that are good for trading are Zerodha, Upstocks, 5paisa, Angel Broking. In addition to this, you will also require a demat account, which is like a vault in which you can hold all your stocks. But the broker itself will provide you with the demat account as well. Let's understand how the stock market would probably function. Now let's talk about a company XYZ. Now this XYZ company has been performing really well over the couple of years, and on top of that, they're releasing a flagship killer phone. It's supposed to be the best phone of the century. At this point of time, everyone has a feeling that this XYZ company is going to go big. So what happens is that there's a demand for the particular stock. In demand in the sense, everyone wants a piece of that action. Everyone wants to buy this particular stock, because of which there's a buying pressure. Because of this buying pressure or this demand, the price starts to move up, right? If the stock price was at 100 rupees, it goes 102. And there's still people buying it, so it goes to 105. People are still buying it, it goes to 110. And people are still buying it, may go up to 120, 150. Now, if you were a person who had bought the stock at 100 rupees, at 150, you're in a profit of 50 rupees per stock. Now this is how the price moves up in case of the stock market. Now similarly, imagine a case where there's a lot of negative news about the company. Like XYZ company was functioning really well, the stock price went up to 150, and then all of a sudden, their mobile phones started malfunctioning. A lot of their mobile phones were exploding. Now at this point of time, there's a lot of negative sentiment towards the market. At the same time, the board of directors for this XYZ company was involved in a big scam. At this point of time, no one really cares about the XYZ company anymore. No one wants to buy the company stocks. Instead, everyone wants to sell the stock. They just keep selling and selling and selling. There's no buying pressure anymore. So now there is a supply in the market. When there's a supply in the market, the price starts to move down. From 150, it goes to 145. From 145, it goes to 140, 130, 120. It comes back to 100. And even at one point, it may even cross 100, go down below to 90 rupees or 80 rupees. What I need you to understand from this is that stock market is nothing but a fight between the buyers and sellers. The buyers try to push the price up and the sellers try to push the price down. So basically, the market participants are the ones who are actually moving the prices of the stock. The buyers in the market are called bulls. Bulls in the sense, you know a bull, right? With their horns. A bull pushes their enemies up with their horns. So the bulls push the price up. That's why the buyers are depicted by bulls. Whereas the sellers in the market are called bears. The bears, if you've seen bears attack their enemies, they use their fists and then stomp their enemies down. This is why the bears are actually called sellers in the market. Bears push the price down and the bulls push the price up. So the next time you hear bullish market or a bearish market would mean that the buyers are in control and that means the prices are moving up. Whereas in case of a bearish market, the prices are moving down. This is the reason why you would have seen a statue of a bull or a bear in Wall Street and all these financial institutions. In India, our stock market actually opens at 9:15 in the morning and closes at 3:30 in the evening. Within this time, the market participants will be placing their orders, entering and exiting trades. Hope you guys got an understanding about what the stock market really is and how it really functions. So if you have any questions regarding the stock market, or if you have any queries, or if you want us to make more videos on particular topics, just leave a comment in the comment box and we'll look into it and make further videos accordingly. So click on the bell icon and subscribe to our channel so that you don't miss out on any of the new content that's coming up. You can also follow us on our Instagram page for further updates about the community and what is happening inside our community.